What did we see? I don't know if the Fed chair expected that kind of reaction. He sure got it. Did the markets overreact?
Well, I think you always have to put it into context. So for just about the past 7 weeks, the markets have been starting to price in much better inflation data. Just remember, at the end of the third quarter in September, bond markets were getting very nervous. Yields were climbing close to 5%, and there was some concern that the Fed was still going to be increasing interest rates. But I think with the slowing that you've seen in the economy and the slowing that you've seen in the employment data and the good progress on inflation, the Fed was really able to bring the message home to the markets this year. It may indeed be a bit ahead of what the Fed had wanted. You saw John Williams today from the New York Fed saying, everyone, just a moment, hold your horses. But we do think that the progress that's been made on inflation is real, and we do see the economy slowing.
But looking into next year, because it's time now to start thinking about next year, have they steered that difficult course between recession on the one hand and continued inflation on the other? Have they managed that, do you think? We think so. At Voya, we have a number of inflation probability indicators and models that we like to look at, and we're forecasting less than a 30% chance of a recession in 2024. In fact, if the data continues on this road that it's on, we think it's probably even likely that you wouldn't see a recession much before 2025. Wow. So what does that say to the investor going into 2024? I mean, what is different now than it was 6 months ago, for example? Well, let's put some things in context, David. Over the past 2 years, the S&P 500 has made very little headway. While stocks are up almost 20% this year, they were down almost 20% last year. So since December of 2021, you've basically been flat on the equity market, which is very unusual. We do see earnings able to climb about 10% over the course of 2024. And if bond yields continue to fall modestly, you know, if you can get rates down to about 3.5%, you might be able to get a little bit of multiple expansion. That should give you 10 to 12% in equities over the course of 2024. I would say it will not be smooth and there will be bumps along the way, but there's reasons to be optimistic. But that's the case for equities. If I'm trying to decide that 60-40 split between equities and bonds going into 2024, which do you think you tilt more toward? The bonds? Because bonds are looking more attractive than they did certainly in recent years. Over the very short term, I would say this. Over the past 7 weeks, most people have really started to pile into the equity market. Most of our sentiment indicators that we look at in terms of short-term temperature of the markets are looking quite extended at this point. You're susceptible to any type of garden variety pullback at this point, just like we had in the summer. There was a 10% peak to trough decline. But I would say the reason that bonds have real yields at this point, you're about 1.7% on a real 10-year treasury. That is great news to asset allocators and investors alike. It means that you're getting a return on bonds in excess of inflation. It's the first time I can tell you we've had positive real yields sustainably since the global financial crisis. So it's a great time for investors to be looking at the actual value and the material value that's in the fixed income markets. Right now, it looks like we have a rising tide, which is lifting most of the boats, right. I think it's fair to say. As you look into 2024, where do you think some boats might get more of a lift and some less? Well, it's interesting, David. So when you think about the Federal Reserve cutting interest rates, you immediately go to some really heavy cyclical parts of the market that should do very well. U.S. small caps have been on a tear since the Federal Reserve started to say that they were going to be potentially not raising interest rates and even nudging them down. But there are some other parts of the market that should have been doing better, but they're not. So something like the emerging markets, you would expect them to do very well when the Fed is taking their boot off the neck of the markets. They have lagged behind significantly, in part because while they're leveraged to the global interest rate cycle, their underlying fundamentals are not particularly strong at this time. So I think you have to be careful when you're talking about the rising tides lifting all the boats. We would definitely stay allocated more towards the U.S. than the rest of the world. Europe is still in recession. I'm concerned that the yen may not rally as much as everyone expects this year. And I think the emerging markets are still in trouble. So for us, we're keeping our U.S. home country bias very much alive and well for 2024. Within that U.S. home country bias, one of the biases we've all had is the Fed. Yes. It seems like every single day all we care about is the Fed. Is that going to continue in 2024? Are we ever going to get past the point where all we care about is what the Fed thinks it's doing or we think it's doing? David, that's a great question. And we all have had the Fed on the brain since really 2021. I think the real issue that we're going to have to face in 2024 that's going to change the market's view is going to be the U.S. presidential election. Over the past couple of elections that we've had, say 2020, 2016, 2004,
2000 as well, it's kind of been this pattern that follows. The market tends to make some decent gains into the beginning of the year, really the first half. And then right around the June primaries, the market starts to say, there's some things that could be uncertain about this election. Could it be another Supreme Court decided election? Is it too difficult to determine who the winner is going to be? And the market tends to get a little bit nervous. The equity market generally has a weak third quarter. And then right around October, there starts to be enough information that the market starts to sniff out who the winner is going to be. And then equities generally march higher into the end of the year. And we would see that as likely replaying this year.
That June timing could be tricky because everybody, even the Fed, agrees we're going to be slowing down the economy through the first half of the year. You could have a slowing economy. I'm not necessarily going into negative, but a lot more modest than it is now. At the same time, you have that market uncertainty. In the middle of the year, what you're saying, I think, is it could be tricky.
It could be very choppy for sure. So why we think that you're going to make decent gains in 2024, in part because your starting point is relatively good. It could be a bumpy 2024 for sure.